And we covered chapter 2 already. So let's close that and go to chapter 3 and go all the way down. So you see in chapter 3, you are learning so many things. That's why chapter 3 is not chapter 3. It's technically 2 chapters all of a sudden in 1 chapter. In other accounting books, you have chapter 3 and 4 for this purpose. But in your book, they put everything in chapter 3 for some reason. So don't think chapter 3 is like, okay, it's not a big deal, it's just 1 chapter. It's not. It's 2 chapters and very important and foundation of accounting, which you need to learn, otherwise it will be kind of hard to follow. So here is like giving you some introduction, accrual, and basis of accounting, which says you recognize revenue when you earn it, doesn't matter when you get paid, and you recognize expense when you receive goods or services and you have the obligation to pay for it. Doesn't matter when you pay. That's the accrual basis of accounting. We have cash basis of accounting also. Cash basis accounting is maybe good for a small business. In cash basis of accounting, you can use it for a small business and recognize expense when you pay and recognize revenue when you receive cash. So cash basis is kind of easy, but for big companies, you cannot use cash basis. It's not acceptable by GAAP either. Publicly traded companies, definitely they need to be accrual basis of accounting. Even IRS wants to know which method you are using. If you are a small business, you might say, check the box that says cash basis of accounting when you file your taxes. Or if you are doing accrual basis, then check the box for accrual basis. So but one more time, under accrual basis, you recognize revenue when you earn it, and you recognize expense when you have the obligation to pay. The method of payment and the timing of payment doesn't matter. The adjusting entries are adjusting entries that you need to do, journal entries that you need to do at the end of the period for things that happened. So that's the adjusting entries. Things like happened are what? Like passage of time, for example. So if because of passage of time, you use the, let's say the office area, so you have the obligation to pay and recognize rent expense. Let's say if you use your equipment, then you need to recognize depreciation expense. That means depreciate your equipment. Remember, when you buy, let's say supplies, you recognize supplies as an asset. And at the end of the year, you recognize how much of that supplies are used. Therefore, for that amount of used supplies, you recognize supplies expense. So recognition of supplies expense is an adjusting entry by itself. If you purchase equipment is a long-term investment. We call it fixed asset that you use in your business, but for not just a year, but for many years. So that's why you need to depreciate your equipment. You capitalize them first. You don't expense them. You capitalize them. That means you record as equipment, but at the end of each period, let's say end of each month or end of each quarter, or at the latest at the end of each year, you recognize depreciation expense. So those are things that you need to adjust. After adjusting entries are done, you prepare adjusted trial balance. By having adjusted trial balance, you can prepare your financial statements. What financial statements? Like income statement first, statements of stockholders' equity second, if it's a corporation. If it's a sole proprietorship, then you say statements of owner's equity. After income statement and equity, statements of stockholders' equity, you prepare your balance sheet. And after balance sheet, you can prepare your cash flow. Then in general, so you know, those temporary accounts will be closed. So what temporary accounts we have? Let's say revenue is a temporary account, belongs only, let's say, to 2022. Expenses also belong to 2022. So expenses are temporary accounts too. So revenue, expenses, and dividend, those are for sure the minimum temporary accounts that I can easily mention in here at this moment. So all these temporary accounts needs to be closed. That means become zero. And why do you make them zero? Because next year in January, let's say 2023, when you want to start your business again, January 1st, you need to have a fresh start. That means your revenue is zero, expenses are zero, dividend is zero, and you start fresh. So according to GAAP, anything happens in the period, let's say in 2022, will be recognized and will stay in 2022. You cannot say, I just want to push a little bit of revenue to next year, or to recognize a little bit of expense next year. You cannot do that. That's fraudulent accounting kind of method that you want to push the expenses or revenues back and forth. Anything happens in 2022, stays in 2022. And then, so you have to close the revenue, and you have to know how to close them. Again, you watch those 4-part accounting cycle for sure. And then after closing entries, you prepare your post-closing trial balance. And post-closing trial balance is the permanent accounts that is open and left, so you can move it to the new year. So post-closing trial balance are those permanent accounts, like asset, like liabilities, like equity accounts, that you take it with you to the next year. So what do you close? Revenue, expenses, and dividend. Temporary accounts. There are some other temporary accounts too, but for now, just those are things that you need to focus. Okay, so let's do some exercise. Okay, so I like to start with exercise, something that relates to your homework. So I'm gonna go exercise 7. I think that's in your homework. Okay, so it says Golden Eagle Company prepares monthly financial statements for its bank. The November 30th adjusted trial balance includes the following account information. So adjusted trial balance, that means a trial balance that is adjusted, and you can prepare financial statements from it. So it shows in the adjusted trial balance that you have supplies of $2,000, that's an asset. Prepaid insurance of $8,000, that's an asset. Salaries payable of $11,000, that's a liability. And deferred revenue or unearned revenue, $3,000, that's a liability. Deferred revenue or unearned revenue, it's a revenue that you received the cash from the customer, however, you didn't finish the job yet. Therefore, you record it as a liability. You do not record it as a revenue yet until you finish the job. So the following information is known for the month of December. Purchase of supplies during December total 4,500. So this is as of November 30th, but just 1 month is left. So purchase of supplies during December total 4,500. Supplies on hand at the end of December equals 3,500. So they purchased at 45, but they have leftover of 35. How do we know how much is left over? You do physical count, and the physical count will provide you the ending balance of that specific account, let's say supplies. Okay, so we're gonna go over those one by one, but it says show the adjusting entry that were made for supplies, prepaid insurance, salary payable, and deferred revenue on December 31st. So let's do one by one. So purchase of supplies during December, 4,500. Supplies on hand at the end of December is 3,500. I should have, this is the problem 7, I believe, right there. Okay, so remember the supplies, the T account was showing, if I look at the book again, was showing 2,000. 2,000, but we added 45. So 2,000 plus 45, that's 6,500 of supplies, $6,500 supplies. Then at the end, 3,500 is left, right? So 6,500 of supplies minus 3,500 left. That means you need to record supplies expense of $3,000. Make sense? So beginning was 2,000. You added 45, so 2,000 plus 45 minus 3,500 left. Supplies expense needs to be $3,000. And here, so you recognize an adjusting journal entry for supplies expense for $3,000. That's a debit to increase the expense. Normal balance for any expense is debit. And you reduce your asset. That means asset will decrease. Remember, to reduce your asset, you need to credit. The normal balance for any asset is debit, but when you want to reduce it, then you do the opposite, which is credit. So supplies will go out of your pocket. It will be reduced. That's your asset. Goes out of your pocket, will be reduced, will be credited. Supplies expense will be debited. And that's how you adjust supplies expense.
I have a quick question. I'm sorry to interrupt you.
Sure.
I just wanted to ask, how did you get 3,000 as your number? Because earlier it was 2,000 and then it went to 4,500. And then what was left was 3,500.
Yeah.
How did we end up with 2,000?
Very good. I like those questions because that's why I am here. Otherwise, I just let you read the book.
Yeah.
I want you to know that you can, even though you took an online class, doesn't matter. I'm here and I put my time so you can have extra resource.
Yes.
Of course, there are, I believe, tutoring too, but I want you to come forward and ask. So this is a good question. So let me stop sharing for a second. I want to, okay. You should be able to see my paper now. So here is supply. That's what it says. You see, everything in accounting, we put it in the T account, and that's how you understand what you are doing. So it says the supply beginning from November, at the end of November, it was, I believe, $2,000. So that's what supply was, right? And then you purchased, it says, $4,500 of additional supplies. So supplies went up, and because of that supplies, maybe you have, let's say, accounts payable, 4,500. Okay, that's fine. So you purchased additional supplies. Now it says at the end of the December, which is end of the year, and we need to figure out what's going on. We have 3,500 of supplies based on physical count at the end of the year, to know how much supplies are left, so we can report that in our financial statements. So
Oh, really quick, Professor. So
Mhm.
you don't want us to add up the 6,500 and write it anywhere on the T chart? Just go ahead and write a line and just put,
no, if you like it, write it, no problem. Here. Here, 6,500.
oh, okay.
So I have 6,500. I draw another line below it, but I say I need to have 3,500 left. So what do I do? So in order to have 3,500 left at the end, then I need to adjust this. So 6,500, how do I get to 3,500? So 6,500 minus 3,500, that means I need to deduct 3,000. So here we go. I record supply expense, 30,000, that's a debit. And then credit supplies. So 65 debit here on the left side, 3,000 credit on the right side. That gives you 3,500 left over. Make sense?
Yes. So the remaining is the credit, which is the 3,000, and we would leave it on that side, on the credit side.
Yeah. That's where's credit side?
Oh,
That one,
right there.
that's what you are saying? Yeah.
Yes.
Those are the journal entries here, right there. You
Right.
see? I did debit supply expense, credit supplies. And now on supply side, I have debit of 65. On the other side, I have credit of 3,000. So 65 minus 3,000, it's 35.
Okay. How come we have to have two different T accounts for a supply and a supply expense?
Those are two different things. Supply is your asset.
Okay.
Supply expense is an expense account.
Got it. Okay.
So when you buy supplies, you record it as supplies. It's an asset.
Okay.
Let's say the company right now wants to go bankruptcy right now. So the company can easily put this $3,500 supplies in eBay and sell it. So it's an asset. Supply expense is just expense account.
Can you list everything on the same T chart under assets on the same subject? So instead of supply, it'll say assets, and then we can just continue with including supplies and all the other factors using the same T.
Let me show you. That's a balance sheet.
Oh, okay. And I know how you listed accounts payable on the other T chart and put as a credit 4,500. Why did we put that there?
Because when I did debit here 4,500 under supply, when I purchased it,
Mhm.
I just want you to understand that when you do a debit of supplies, then you have to credit something,
Okay,
right?
got
So
it.
if I just debit here and you know what I'm doing, you will say, wait a moment, if that's your debit, where is your credit?
Okay, understood.
So here I have a chart of account. You see on the chart of account, you have a bunch of account that you have to put in the chart on the day one of your accounting process for any company. So when you are setting up your chart of account, you start with asset and then liability and then equity. So asset is starting in chart of account with 1. So that's 100. Let's say, I'm not suggesting to use 3-digit in a real business, but like 5-digit is good. But here for a classroom, 3-digit is fine. So starts with 1, bottom line. So asset starts with 1, between 1 to 100 to 199, 3-digit minimum for a classroom. So when you have asset, then is asset like what? Like 110, like cash. 115, accounts receivable. 120, supplies. 120, let's say 2, prepaid, whatever, prepaid insurance. 125, inventory. 128, prepaid rent. So those are all your assets. And then continuing on your chart of account, below current asset. Current assets are assets that you can liquidate it into cash within a year or less. The second category under current asset is investment. So long-term investment. Let's say you lend someone money and you call it note receivable and you collect interest, literally, right? So that's an investment. If you have a land that you rent it to someone as a form of investment, that's investment, 135. If you have a building that you rent it to someone, let's say you are in business of selling t-shirt, but you also bought a building and you rent it to someone. So that's investment. So those are 130, 135, 140. But after that, you have equipment that you are using in your daily business operation. You call it property, plant, and equipment. You see, it starts with 160, 170, 175, 180, something like that. So every account has a number and has a specific location in the chart of account. So intangibles are the next category of assets. Those are like franchise right, patent, goodwill, copyright. Those are asset, but intangible asset. You cannot touch them, but those are assets. Like building is tangible, equipment is tangible, land is tangible, but intangible assets are not. Like tangible assets, like equipment and building, they depreciate. You at the end of the year, you have to record depreciation expense, adjusting journal entry. But land never depreciates. So the next category of asset, we call it other assets, that they go at the bottom of the line, like 198, 199. And those are things that you don't know where to put it, like employee advance or security deposit or something. So you put them in other assets. Any question on chart of account in regards to asset and where every account goes and what account number it should be?
Yes.
Please.
So under investments, you indicated loan receivable, land investment, and building investment. And then the following, I can't remember what that is also, but it's also
PP&E, property, plant, and equipment.
property, plant, equipment. How come we have to separate that from investments?
Yeah, because as I said, let's say you are producing t-shirt. That's your work. That's your job.
Okay.
For making a t-shirt, you need some equipment and you need a factory. So that's your equipment. That's your factory. You use them every day in your business.
Mm-hmm.
But this one, those investment, those have nothing to do with producing t-shirt. Those are just because you have extra money, you put it somewhere for long term.
Okay.
To collect either rent, additional interest income, or something. Or you might invest in some stock of other corporations. Those are things that it's not used in your daily business operation. Those are investment. So you categorize them as such. But property, plant, and equipment, those are things that you use them in your business. And that's why I said you need to depreciate them. So when you have equipment, then right below equipment account, let's say 161, it's accumulated depreciation dash equipment. It's a contra account. You have a building, right below building, you have account 171, which is accumulated depreciation building. So that's how you show how much has been depreciated so far. So those two are account that they are connected to each other. Those are contra account to your main account. Again, contra account to your main account. Those are things that you are using and you are capitalizing them first when you purchase them, and then you depreciate them down the road every year as a form of adjusting journal entry. But those things are investment. So you invest in those and you have extra income because of those. It might be stock investment, imagine. Even though you depreciate this building also, but this building depreciation is depreciated because of it's invested and you collect rent. So it's a rental income and it's an extra income that has nothing to do with your business, even though it's an investment, but you can depreciate your investment because you're collecting income as a form of rent income as extra type of income you might have in a business.
Okay. What is a contra account?
Contra account, that means in under GAAP, it says if you have equipment, let's say this is your equipment. And you have, let's say, $100,000 worth of equipment, right? And you have, because of that, you have a mortgage payable, 100,000. So you purchase the equipment for 100,000 and you have a mortgage, you have a loan payable for that. And then at end of the year, you want to depreciate that equipment. So you calculate, you say, okay, I have $100,000. And you say, okay, $100,000 minus estimated. It's just an estimate. Estimated salvage value at the end of the year. So here is your asset. Here is your salvage value estimated. Let's say 10,000. So asset minus salvage value is 90,000, and that's depreciable amount. So how much is depreciable amount? Is 90,000 after deducting estimated salvage value. You might say salvage value is 0 or anything else, but you are estimating that and you believe 90, and salvage value means after 10 years of life, let's say you can sell it for that much. That's what you estimate. Then you divide your depreciable amount of $90,000 by estimated 10 years of useful life. And that gives you equals to 90,000 divided by 10,000 is $9,000 annual depreciation. So now that you know what your annual depreciation is, GAAP says, okay, now it's end of the year, you used it for, let's say, 12 months. So recognize the depreciation of that equipment. Because you capitalize the equipment, now is a time to recognize some form of expense. So you capitalize them, it's an asset, but GAAP says if you want to depreciate that, don't touch the main asset. Let people see how much was the original equipment all the time. So in order to not touch this, I create a contra account. I call it accumulated depreciation dash equipment. Accumulated depreciation dash equipment. Accumulated, that means, you know, accumulated on top of each other year after year after year. So right now, I'm going to record how much? 9,000 for year one. So that's $9,000 accumulated depreciation. And because of that, I record so depreciation expense dash equipment, and that's a credit. So here is the debit. So now I have depreciation expense. So if someone says, wait a moment, you are buying equipment, but you don't recognize expense, you say yes, because it's a long-term equipment, fixed asset. So I'm gonna capitalize it. However, I'm gonna record depreciation expense at the end of the year. And now I have accumulated depreciation. So now at the end of the year, how much equipment do you have left in your balance sheet?
Is it the 100,000 minus 9,000?
Yes. So
It
if
would-
this is your balance sheet,
Mhm.
you say you show equipment. In your balance sheet, you show equipment of $100,000. You see, because I didn't touch the T account over there, because I didn't touch that, so I can easily show everyone that how much equipment I have, which is 100,000. That's original cost,
Mhm.
less accumulated depreciation dash equipment, and that's 9,000. So now 100 minus 9 is $91,000 net equipment. So someone can look at the balance sheet and figure out that how much equipment I have easily. Question? No questions?
No questions. I think I'm okay now.
So here we go. So we were trying to recognize the supply expense, and we did it. So it was supplies when we purchased them, but at the end of the year, we recognized proper amount of supply expense for the year, $3,000. So go back to sharing my screen again. And let me turn off the camera for a second. Okay, next one, it says no insurance payments are made in December. Insurance cost is $2,000 per month. So we have prepaid insurance of $8,000 as of November, but insurance cost is $2,000 per month. So December is gone, and that's where we need to recognize the, the insurance expense for month of December for $2,000. So if I want to show you the T account, I would show, let's see, a T account of insurance. And that's how much prepaid insurance. Prepaid insurance of $8,000. I'm going to show you the T account. Just let me write this down. And then here we go. So here is the prepaid insurance of $8,000, but it says cost of insurance each month is $2,000, and for month of December, we need to recognize that $2,000 additional insurance expense. So here we have insurance expense. We have some balance in it already. I think that should be for 11 months. 11 times 2 is 11 times 2 is 22,000. So I can say that's 22,000. But for month of December, still we need to recognize it. So I'm gonna reduce this 8,000 by 2,000, and I'm gonna increase insurance expense by 2,000. So that way, my prepaid insurance ends up to be only $6,000 balance as a form of asset, and my expense for the insurance will end up to be $24,000 as a form of insurance expense. So who is doing those adjusting entries? Again, the accountant at the end of the period. Questions?
So Professor, you started at $8,000 because that's the prepaid insurance amount. And then you basically included the 2,000 payment for the following month of December, which
There's no
brought it down
payment.
to the
No,
remaining.
there's no payment. There's no payment.
Not payment, I'm sorry. For the insurance in December, that needs to be paid. Isn't that what it means?
No,
That's what
no,
it said in the
No,
question?
it's already paid. It's already paid. I have 8,000 in here. It's already paid.
Okay, but
It is
when you're-
just accrued interest, not interest, accrued insurance.
accrued
expense.
insurance. Okay, yes. So then you would come down to $6,000 after that.
Mhm.
That's been taken care of. And then the $22,000 is basically 11 months of the insurance times 2,000,
Yes,
right? So that you get 22,000 and
that's
then
how I know it's 22. It's not given, but based on a statement that says $2,000 a month. So I'm just estimating, yes, 11 months times 2,000, that should be 22,000 insurance expense.
right from November, and then you go ahead and include that same 2,000 starting from December, and which would lead us down to 24,000 for the year. Is that what it is?
That makes sense because 12 months times 2 should be 24. Yes.
Okay, understood now. Thank you.
So that's another adjusting entry again we did. But let's get back to sharing screen for a second. Okay, so I'm sharing my screen. The next one says November salaries payable was 11,000. So let me put it in the T account. You see, anything I'm doing before I continue, I constantly use a T account to see. So I'm gonna add this T account. It says salary payable, and that's liability. That should be on the credit side. $11,000. They're paid to employees. November salaries, no, yes, no, okay. November salaries payable was 11,000, and we're paid in the December 11,000. Okay, additional salaries for December owed at the end of the year are 16,000. Okay, so let's go to the T account. So that was in end of November, but it says, although we have a lot of cash, okay? So it says this salary payable of 11,000 already is paid. It's already paid in December. So it was in the November, but already paid in December. So cash goes out of pocket, that's a credit, liability closed. So there's no liability. However, it says at the end of the December, because of those hours that employee worked and still we didn't pay them. Normally we pay them, let's say in January 5th or something. So how much do we owe them for this? We need to recognize anything happens in 2022 stays in 2022. Remember? So here is $13,000 of liability for payable. So no, 16,000, sorry. So $16,000 of liability, that's a credit. And you recognize it as salary expense. That's 16,000. Okay, so debit salary expense, credit salary payable, and that will recognize the salary expense for the month of December. Debit expense, credit liability. Questions? Okay, so if I remove pin, share screen, and then show you my answer, here we go. So that's supply expense that we did. That's a debit. Insurance expense was $2,000 debit, prepaid insurance credit, which we did it already. And then we recognize another $16,000 of salary expense. That's a $16,000 debit, and recognition of the liability for the end of the year. That's $16,000. Make sense? Questions? Okay. The last thing I believe left is on November 1st, a tenant paid Golden Eagle for the $500 in advance rent for the period November through January. And deferred revenue was credited for the entire amount. So $4,500 for November, December, January, 3 months. That means $1,500 a month. So on November 1st, a tenant paid Golden Eagle $4,500. So this is a deferred revenue, deferred rent revenue. We already recognized $1,500 of it in November, but still we have $3,000 left in deferred rent revenue, and we need to recognize another $1,500 for month of December. So here we go.
Professor, how did you get 1,500?
4,500.
Oh, no. Oh, was that what it was? We divided it within the 3 months?
3 months is 1,500. And
Okay.
here we already, you see here, we already recognized November rent expense, rent revenue. But still we need to recognize December rent revenue.
I understand. Okay.
So stop sharing, going back to the camera. So what it says, this is what happened. It says in November, I'm showing something in November so you understand. In November, someone gave us deferred rent revenue, and someone gave us cash, $4,500, which we put in our pocket, and we were so happy for it. However, we recognize it as a credit. That means liability, right? And it says now it's $3,000 left in deferred revenue at the end of November. How come we have 45? Because at the end of November, we recognized rent revenue. At the end of November, we recognized rent revenue of $1,500, and we reduced the liability by $1,500. Therefore, it's $30,000 left in deferred rent revenue. And this is where I'm referring to it. Here is 3,000 right there. You know where this 3,000 is coming from. So now for month of December, you know that another month is passed. So you record the accrued rent revenue. So accrued rent revenue here right now gonna go up by another $1,500, and your deferred rent revenue gonna go down by $1,500. So 3,000 minus 1,500 is 1,500 on the credit side. So liability, normal balance, credit side, 1,500, and rent revenue will go up by 1,500. And that's your adjusting journal entries. Questions? So we have two types of adjustments that normally you do besides recognition of depreciation expense. You we have deferral adjustments and accrual adjustments. What's the difference? Deferral adjustments are adjustments that you received cash and you deferred the recognition of revenue to future time. That's why we call it deferral adjustment. So here you receive cash. You see that $4,500 cash that you received for rent in advance. You deferred that to future as a form of liability, and you didn't recognize revenue. You deferred the recognition of revenue. But now, every month that is passing, you are doing a deferral adjustment. Deferral adjustment, that means an adjustment that you deferred to the future, and now you are recognizing the deferral adjustment. But we have also accrual adjustment. Accrual adjustment is different. Accrual adjustment means something accrued. Like what? Let's say you borrow money many years ago, and every month you need to accrue the interest. Let's say $100. So every month you recognize that accrual adjustment. That means you recognize the passage of time for 30 days, and you recognize the accrual of $100 interest. That is, you didn't receive any cash or something, but you just recognize the accrual of that. So remember the salary expense here, and we did the $16,000 salary payable recognition. That's an accrual adjustment. That means because of passage of month of December, something accrued. What accrued? 30 days, let's say your employees worked, and that's an accrued adjustment that you need to recognize accrued salary expense. So that's an accrual adjustment. But when you receive cash in advance or pay cash in advance, and then you defer the recognition of it, then it's a deferral adjustment. So in deferral adjustment, in some shape or form, you either paid cash or received cash, and you deferred the recognition of expense or revenue. And when you do the adjusting entries, you call it deferral adjustment. Accrual adjustment, that means you never received cash or paid cash, but something happens like passage of time. And because of passage of time, something happened. Let's say now you owe salaries to your employees, or you owe interest for your loan. Questions? Okay, so that was the technically adjustments that I did. Let me unpin. No, okay, let me turn off this one and share my screen. Okay, so on November 1st, a tenant paid Golden Eagle $4,500 in advance and rent for the period of November through January, and the deferred revenue was credited for the entire month. So, and I did show you the solution, which is debit deferred revenue, deferred rent revenue, $1,500. So now you are reducing the liability, and you record rent revenue or service revenue or whatever reason you got that cash for, and that will be $1,500. Make sense? So in your chapter 3, you are learning how to recognize adjusting journal entries, how to prepare adjusted trial balance after adjusting journal entries, using adjusted trial balance to prepare financial statements. Financial statements are income statement first, and then statements of stockholders' equity, and then balance sheet. And that's how you prepare your financial statements. In chapter 1, you might learn already how it goes forward if you remember chapter 1. So this is just to confirm the same process. Income statement first, statements of owner equity second, and then balance sheet third. So adjusting journal entry is very important at the end of each period. If you don't do those, your financial statements will be all wrong because you are not reflecting the reality. So those are the adjusting entries that you see right there. Any question, please? Anyway, so what you need to do, one more time, I'm just emphasizing the 4-part accounting cycle that I did in the video training. I did it on an Excel document. Excel document is provided to you. Your job is to watch the video, 15 minutes, stop, do it on Excel yourself. If you couldn't do it, watch that 15 minutes again. And then make sure you do it on the Excel. Your results has to be same. And then watch the video another 15 minutes. Whatever I did, put it in the Excel, back and forth. And piece by piece, you go forward till at the end, you say, okay, I can do this like piece of cake. You can use another Excel, just the same documents, blank, and do the same thing, which I explained it, let's say for 1 hour, you can do it in 10 minutes, right? Because when I explain, it takes time, but when you want to do it, it's just 10 minutes. And then go to part 2, and then part 3, and then part 4. And at the end of part 4, the whole thing that I was doing in 4 parts, which is probably more than 4 hours, you have to start your Excel documents from blank to all the way to the end and get the exact same results in less than 1 hour, close to 45 minutes. If you can't do that, that means you are rusty. You have to practicing more. It's going to say, like company did this. This is the information. And then it says, what is the journal entry to record supplies expense, for example. Okay, so you read it, you look at the information, and the question says, what is the journal entry to record this? And then you have to say, okay, the journal entry is multiple choice, let's say. You have to choose the best answer.
Yeah, okay.
Yeah, let's say this one says, next question in your exam says, this is the situation, and what is the journal entry for this? For that. And then you have multiple choice and you have to answer it.
Thank you.
So it's a multiple choice. But multiple choice might be easy, might be also hard, because if you don't understand the concept, then multiple choice will be very hard, because you have absolutely no idea what they are talking about. And the reason you will have no idea what you are talking about, because you didn't study. You didn't cover chapter 1 properly, you didn't cover chapter 2 properly, and definitely you didn't cover chapter 3 properly. But if you practice those chapter 1 to 3, read the chapter. No, that's normally what I do. If I was a student, I would master those 4-part accounting cycle video with the Excel document that is provided like a piece of cake. I would normally, even right now, if I want to learn something, I need to read it 3 times. So chapter 1, chapter 2, chapter 3, normally I have to have 3 times of coverage in order to absorb the information. So normally you read once, you do some exercise problems, and you read twice, and you might need to read third times to get the idea and stock all the information. So this is not a English class that I say, okay, write an essay and you will be done. This is a technical class, and you will to know every single thing, because every single time you use a wrong word, the whole scenario is changing. So every single word is important.
Quick question, Professor, on the homework. Is there a place where we can click to see what the answers are if we have anything that we missed?
No.
Oh, there isn't. Okay.
No, but in the homework that I provided in Connect, you can check your work. So I normally other instructors, they give you 3 check your work opportunity. I gave you, I think, God, maybe 20.
Yeah, it's 20 times.
Yeah. So if you think, let's say here says equipment costing $42,000 is purchased at the beginning of the year for cash. Okay, so you record debit equipment, credit cash. Okay, depreciation on the equipment is $7,000 a year. Record the necessary adjusting entry. So already the depreciation is given. Remember this, for this depreciation, I did show you how to calculate it. Remember? If not, watch this recording again. At the beginning, I did show you. Total asset minus estimated residual value or salvage value. That gives you depreciable amount. Divided by estimated useful life. That gives you annual depreciation, which in my example, I calculated it was $9,000. Here, it's given to you. So this is literally babysitting. This is way too easy because it's just given to you. If it was me, I wouldn't give it to you. I would say, give you the information and I would say you need to calculate it. But here it's just given. That's fine. So the question is, what is the journal entry? So you need to know what is the adjusting journal entry for this. So what is it?
It would be six.
What?
6.
By 6? It says 7.
Oh, I'm sorry.
It
There's
says
a
depreciation expense 7,000 debit. Accumulated depreciation dash equipment credit $7,000. So that's the right answer. Simple as that.
Okay, so you're just inputting is all it is, pretty much. Because it already gives you the
Yeah,
answer.
because it's given to you. It's, I mean, easier than that. All you need to do is just record what is debited, what is credited. So depreciation expense will increase and accumulated depreciation will increase. So if you do the same thing for year 2, how much would be your accumulated depreciation total balance? Year 1, 7,000, year 2, 7,000, accumulated depreciation total balance will be 14,000. Make sense?
Yes.
Like here in exercise 8, which is again your homework, it says interest receivable, you need to recognize it. That's fine because someone borrow from you and they owe you interest. So the accrued interest needs to be recognized. So you record the 1750. But how do you calculate that 1750? Interest revenue equals to principal times interest times, let's say, 6 months out of 12 months. Because they, let's say, borrowed 6 months ago. So 6 months out of 12 months. Interest rate is always annual, so that's 7%. So principal times interest times time. And that gives you interest revenue. And that's how you recognize interest receivable and interest revenue. Doing this, you recognize the accrued interest income. Make sense? Questions?
On the homework for chapter 2, I kept mixing up like the debit and credit, what they exactly are.
You have to know what is the normal balance for every account. Do you know what's the normal balance for asset? Normal balance for asset. Any asset.
Normal balance.
For any asset. You know, that's why you are mixing up, because remember at the very first day I said, if you pay cash, okay, let's remember this in very first week. I told you if I give you $100, where do you put it?
in your pocket.
Yeah.
Why? Because it is close to you,
Closest to
right?
you.
Okay.
Yeah.
So when you are putting $100 into cash account, where do you put it? Do you put in a debit or credit?
Debit.
Because
Why?
it's the
'Cause it's
closest. to you.
closer.
Because it's closest to you, right? Okay, but let me share my screen. Give me last time. I mean, not chapter 1, I mean. And I said, this is cash, this is debit, this is credit, and this is revenue. So you did a job for someone and someone gave you $100. Where do you put it? And I said, if you are standing
Cash.
right here, the closest is debit into your pocket. Make sense? And you said yes. That's a debit. And the other one has no choice, becomes what? Credit. So debit cash, credit revenue. Did you agree on this last time? I mean, first week?
Yeah.
Okay. So if you debit your asset, so let's post this. So here is cash, debit $100, and here is your revenue, credit $100. So one more time, if you get $100, where do you put it?
Debit.
Debit. If you get any asset, where do you put it?
Credit.
If you get any asset, cash is an asset, agree?
Yeah.
Okay, if you get any asset, where do you put it?
Debit.
Debit. Normal balance is debit. Asset, debit. Asset, debit. Normal balance for any asset, debit. Remember, I said you have to repeat this to get to memorize it to the point, right? And I said, for now, I have a good example, so you don't need to memorize it, but eventually you should. So here we go. So normal balance for any asset, debit. Normal balance for any revenue is
Credit.
credit. Revenue,
Credit.
revenue.
Credit.
So if I say there is an expense, let's say rent expense, let's say $1,000. Which side should I put it? Normal balance for any expense. Normal balance for any expense,
Debit.
debit. You have to know that. Why? Very easy. Here is why. So here is rent expense. Here is cash. So cash goes out of your pocket, right? Far away. That's $1,000. So something has to be debit. Remember I said, if you are standing here, cash goes out of your pocket far away. That's a
Yeah.
credit. But that's a credit, $1,000, right? And that's a rent expense debit. So because you know this 100% correct, right? The other one is correct. But I said, eventually you have to learn. You have to say, okay, normal balance for any expense is debit expense, debit expense, debit expense, debit expense, debit expense, debit. So if I ask you right now, what's the normal balance for any expense, you have to tell me.
Debit.
If I ask you what's the normal balance for any asset,
Debit.
debit, any revenue, normal balance,
Credit.
credit. So hopefully that makes sense. But the point is, one more time, when you take an accounting class, make sure you have time for it. That's the most important thing. Make sure you have time for it. Make sure every chapter you master it before you move to chapter 2. So if week 1 we are covering chapter 1, then you have to master chapter 1. You cannot say, okay, you know what, I'm going to take a little bit of break, and then when we are in chapter 3, I will do something about it. That's way too late. In accounting, you have to be super focused, super organized, and do everything on time. exactly on that week. Master it before you move to chapter 2. Otherwise, chapter 2 and then chapter 3, it will be a disaster. I'll see you next week.
Thank you,
Bye-bye.
Professor.
Thank you, Professor. Have a good one.
Bye.
Bye-bye.
Bye-bye.
Bye.